Yeah, there's a lot of cautious optimism. Another factor is there's 6 fewer days, and November could be tough if it's warmer. So there are fears around the mall and also women's apparel. That being said, there are some great opportunities. I would go for value. I would go for grocery. You think about business models like Costco with an excellent product assortment at great prices. We like Walmart and Target as well, and Planet Fitness is a great bargain too. So how do you and what do you own in an environment where the consumer environment's getting tougher?
Yeah, Planet Fitness may be more of a January play, but I'm struck by the absence of department and specialty names on your list.
Yeah.
Is that because of, it's just not your coverage, or is it because those names are just not going to work, with the exceptions for players like Lulu?
We have so many problems with mall and mall traffic, the less productive mall, and traffic is running -3 to 5. Also, the battle with Amazon is a big factor too. So physical retail is profoundly changing, and companies like Macy's and other department stores really need to close stores and repurpose their stores, and they're competing hard against off-price sector, which is a clearer value. Also, you can get great clothes at Target and Costco, and that's where this shopper is shifting to too. As far as clothing, we like a business model called Revolve. It's digitally native and it's profitable. Being profitable and digital don't often go together, but the Revolve business model is something we like in apparel. But women's apparel, the changing taste in apparel, versatile dressing, athleisure, these are all factors that are leading to tons of competition, and it's very difficult for the traditional department stores.
You like the winners in the group, Oliver, that everybody else seems to like, the Costco, Walmart, Target. At what point, though, do they get expensive, not just relative to the group, but relative to themselves?
Yeah, the Target PE multiple is 17 times. Walmart's at 22 times. Target's also growing EPS at low double-digit rate, and Walmart's slower. So we like Target especially because the PE is more attractive relative to Walmart. What we see is a world of retail and robotics, retail needing more capital, also curbside pickup. That's a big, big deal, and you need capital. So the bigger getting bigger and the stronger getting stronger. And as we approach this season of tariffs, fears, cross currents, recession, these are nice, safer places to be where they're expensive but worth it. But what we focus on in terms of the analytics is looking at the PE multiple relative to the EPS growth. And right now we're in a good place with these business models offering you great dividend yields as well as global growth. And don't forget Amazon. The reality of owning retail and consumer is how to compete.
Yeah, Oliver, it also strikes me that Boot Barn is on your list. It's kind of the outlier, especially with some of the footwear tariffs that people have been concerned about. So explain that one.
Well, Boot Barn is a very special retailer with lots of unit growth ahead of it. Also, what we see with Boot Barn and Ulta is if you can specialize really well in the face of Amazon, you can have a compelling growth story. Also, a boot ticket price is fairly high, over $100. It's an investment piece. It's a piece you may need for work. Those are aspects which give it pricing leverage as well. So that's an interesting special story. And what you should do in this environment is either go high end, think about LVMH, think about Tiffany, go low end, or if you specialize, you have to be awesome. Ulta and Boot Barn are specialists.
You like Ulta still, Oliver? We got to go, but I have to know.
We do. We think it's Gen Z relevant. We think beauty is a great category, digitally native, etc.